I don't know if I should say who he is, but I've seen an Instagram where the guy's like, why would you buy a house? Why would you buy your primary?
Buy your own house first, please.
Yeah, that's how you build legacy wealth. There's so many good things about buying your primary, owning your primary. Yeah, you can't go into a property and say, I know if I do all these repairs, I think it'll sell for more than everything else in the area. The appraiser goes out and says, designated rent's $2,600 a month. Even though everybody there is paying $1,000 a month for rent, we think it's $675 a door. We're like, we're dead in the water. And you battle and you do everything you can to get that appraiser. These are the other market rents. Like, and why are they paying $1,000 a month if it's $675? Why would anybody in their right mind do that?
JMJ Financial, the podcast.
We got Kip Adkins with us here today with Diversified Solutions Fund, specializing in
Diversified financing solutions.
Financing solutions.
Yes.
Specializing in fix and flips, construction loans, short-term loans, investors, stuff like that.
Yep.
So yeah, just wanted to get your perspective on the market, these types of loans, how investors can get into this type of thing.
Yeah.
And we'll take it from there. So thanks for joining us, Kip.
Pleasure to be here.
Yeah, if you want to tell us a little bit about your business, though, just to get started.
Yeah, so like you said, we do the renovation loan, the fix and flip loan or fix to hold loan, which is some advance on purchase and 100% of the construction reserve. So if a borrower has a down payment and they don't have the funds to fix that home up, this is all investment purpose only, that we give them the funds so that they can do the construction, bring that property up to market value, gain that additional equity in the home, and then sell it, fix and flip, or fix to rent. So they're fixing it up, bringing it back up to the homes in the area, commensurate to all the nicer homes in the area, and renting it out. So we offer the full suite from fix and flip loan to the exit loan in the BRRRR strategy, right? So the third R, we do that refinance as well, and we can get them into a DSCR loan based on property rents, no borrower income requirements. We do ask if they're employed, we ask what their income is. We don't verify any of that. So we're not looking at W-2s, we're not looking at tax returns. If you have the capital, then we're assuming you can make the debt service. You have to have 4 months of debt service built into that as well. But yeah, that's basically what we do. And I went a little long there, but
no, you're fine. Yeah, actually, I was going to ask about that as far as, because these are short-term construction loans and fix and flip loans. So, and you do have the option as well to refinance with you.
Yeah.
After the fact if they want to hold the property.
Yep.
Yeah, so that's definitely good info to know as well.
Yeah.
Yeah. Right on. Well, yeah, Kip has helped me out personally with one of my clients who's gotten into investing. He's a general contractor. So he's worked on numerous properties in the past, finally took the dive and started doing the investing himself. So we've gotten to work on a few deals now together here.
Yeah, great borrower.
Borrower. He's a great borrower. Yeah, and Kip's been great as well. It's super easy to work with. It's definitely a different world from traditional financing for, primary residence type or even just investors that want to rent out a property, because it essentially is just like an asset-based and then experience-based qualification, right?
Absolutely. Yeah. We still look at FICO score, of course. Mm-hmm. It's always the best judge of character, whether or not, the borrower's propensity to pay their bills, because there's debt service on these loans, right? So we do look at credit and experience, and then, check the box on borrower qualification on those two. And then it's onto the asset. We underwrite the asset and whether or not the borrower is going to get lift from their planned repairs in that property, and then what that lift will be, what that after repair value is. So we can get into, I don't know how far you want to go into the underwrite. I can break it all down. I do this, 100 times a day. So
yeah, well, when it comes to after repair value, it's similar to appraising and all that stuff. So how do you determine, how does the investor determine what the actual after repair value is going to look like? Are you looking at, hey, let's get what's the floor plan going to look like when we're done, and then compare that to a property and find something that's similar? Or what are you guys doing specifically to arrive at, hey, this is going to be worth this much money when when whoever's done with the project?
Yeah. So I mean, I think anybody who's looking at an investment property, a fix and flip property, they've got some idea of what that neighborhood value is, right? And they're looking around and saying, okay, that house sold for, $3 million, let's say. And they can pick this property at 1.7 and make repairs and bring it up to that $3 million. They've got to have some general idea. You can't go into a property and say, I know if I do all these repairs, I think it'll sell for more than everything else in the area. Everybody's got to have some general underwrite as a borrower, as a property investor, to figure out what can they sell that property for. And when we have that initial conversation, just like we do with our favorite borrower, right? We go in and say, well, why do you think it's going to sell that way? Well, look at this property across the street. Look at the property next door. Look at all these properties in this area, and the average is this. So we'll do like an initial underwrite in the conversation, but it all comes down to, what are you going to do to that property? So let's look at your construction plan. Let's look at what you're planning to do to give it that lift. And then we give that to an appraiser. The appraiser says, okay, you're buying it for 1.7. Let's get a as-is value and verify that's market value the way it is now. So we get an as-is value. Then the appraiser goes, looks at that scope of work, the plan on the construction, and says, okay, you do all this work to it. Now I'm going to find homes commensurate to what that condition will be when it's done. And they give us that after repair value. So it's always verified by a third party. And that's for our underwrite. That's so that we know, hey, this guy's going to make money in this deal. It's got juice in the deal. We don't ever want to, I could write a loan for somebody, but if they're not going to make money, like I tell people, don't do this. This one's thin, it's not going to work out for you, or it's just not supported, Lost my train of thought there.
That is an interesting point because a more famous podcaster than us, Brandon Turner, who's right. I heard him tell a story one time about the one time he lost out on a deal. His lenders were like, this is a bad deal, don't do it. Or basically they wouldn't lend on it.
Yeah.
And he forced the issue and did it anyway. And he's like, I should have listened to them because it was a bad deal and I ended up losing money on it. So it's almost like sometimes when you have a hard time getting a loan, you should take that as kind of the canary in the coal mine, right? They're trying to tell you that maybe this isn't something you want to do.
Yeah.
On the appraisal front, I think that what we're getting at is that it's really similar to just buying a regular house. The difference is that you have what it is today and you imagine what it's going to be.
Yeah.
As opposed to like other appraisals with like a cost approach or an income approach. It's still, you're looking at comparisons and you're seeing what the local market is.
Absolutely.
Right?
Yeah. I regained my thought there. The reason we do that is for our underwrite. And again, back to the whole, should you do this deal? It's protection for the borrower, right? Like we're not going to write you a loan just so that we can rip a couple of points and we get yield on our money. We're going to make sure that you're actually going to be profitable. And we take it a step further too. We take that construction budget, that scope of work, and we bring it to a third party and we go, is this market value? If the guy's a general contractor and he says, dude, I can do an addition and I can do the kitchen and the bathrooms, I can get it all done for $100,000. Let's send somebody out there and verify that can be done. So we send somebody out. It's a third-party construction review. They look at it and go, yeah, you can't do a roof in this area for $8,000. It's going to be $20,000. And they go through that budget and make sure everything jives. And again, back to protection for the borrower, protection for us, lending out the money. So yeah, I wanted to bring that back.
Does that change based on the experience of the borrower? If you have somebody who's doing 20 flips a year compared to the person that's doing it for the first time?
Oh, for sure. Yeah. The guy that's doing it the first time is the guy that's going to come in with a budget and say, I can do this for this amount. Don't lend me the money for the construction. I'm going to handle it myself. I'm going to run up my credit cards and we're going to make sure you can get this project done. Get that after repair value. We're going to lend you the money in that part. But the beginner guy, the novice, is going to have a little bit harder time without the construction, without the experience of writing those checks, trying to figure out what it's going to cost them. And even the experienced guy, again, the story might be, I've done this a million times and I know I can do it for that price. Well, let's just make sure.
And how does the experience factor affect how aggressive you can be on lending?
Good question. We limit exposure as a lender. We limit our exposure for a new guy. Typically 80% of purchase is what we'll do, LTV on purchase. If someone's done 3+, they've got 3 deals that they've been in and out of, we'll go a higher advance on the purchase. This guy's got a proven track record. He's got proof of concept. He's exited these deals, or he's refinanced these deals. He's got that experience. We'll go to 85% and sometimes 90% of the purchase. It comes back to, again, those 2 factors, right? The experience and the FICO score. So for my product, if the borrower has a 700+ FICO and they've got 3+ deals, then we'll start that getting up to that 90% advance on purchase.
Interesting. Yeah. And then as long, obviously, as it all checks out with the after repair value as well and whatnot. Yeah. So they can essentially get in at 10% down with that experience, and that allows them to do more. Yeah. Obviously, because they can use their capital elsewhere.
Yeah, we want that guy to scale. I mean, that's what it's about.
Yeah. How's the market in California versus out of state? Like if you had a newer investor coming to you, had some capital, has a vision, they want to start their investor fix and flip business, let's say, would you recommend, assuming they have the capital for California, I know prices are higher, but would you recommend here versus a different state? Is it easier? Does it not really change too much?
I mean, it doesn't change too much. The risk for us and the borrower, if you're not in that market, you don't live in Cleveland, Ohio, how do you manage that from California? Mm-hmm. And how much of what's your scope of work? What's your level of renovation? If it's a heavy reno, out of state, first time, that's going to be we're going to be a little bit more conservative on the leverage. If they've got the experience and they're out of state, then again, that kind of checks that box. But California, we live in Sunshine State, and house price appreciation on top of a property that needs a little bit of repairs, it's dated, or it's underdeveloped. There's a ton of juice. There's always a ton of juice in California. We love California, but there's tons of opportunity. We lend in 26 states. And I have borrowers that are here and going out of state, and there's tons of opportunity there.
I've heard that if you're an investor and you're looking to flip a property, the math is simple in that you take what you think you're going to be able to sell it for, you subtract out how much you want to make, you subtract out how much you think it's going to cost, and that's how much you can offer. And if you can buy it for that number, then great, right? So the things that change with that are the cost, and you get scope creep, and unfortunately sometimes people get contractors that don't do a good job and you have issues there. So your cost can increase, which skews the numbers. And then the other piece that could change is how much you're going to sell the property for, right? Those are the 2 large stroke main variables that you're going to see. For sure. So that's one thing that I see as a pro to more stable appreciating markets like what we see in a lot of California, is that you're not as worried about market fluctuations because it is a little bit more stable compared to markets that have lower price points.
For sure. Yeah. Yeah. And that's just because we have outrageous house price appreciation here. Yeah. Yeah. If the project goes long, I mean, the chances are it'll probably appreciate in a more volatile market. You might have, who knows what it's going to be if you have a 6 or 8 month project, what's the market going to support in 6 or 8 months? It's not that volatile, of course, housing's not like the stock market, but yeah, there's a little bit of risk there too.
What are you seeing then, seeing that investors need to think about that, right? What is this going to be 6 months, 8 months from now when I sell it? Are they chomping at the bit? Are they weary because of all the variables with election and whatever else that's going to come down the pipeline?
Yeah, I would say real estate investors are a little bit more insulated from that kind of stuff. If you buy right, you find that property in a neighborhood that's got a $400,000 average sales price, and that's what the after repair value is. It's buying right. I don't think a lot of people are thinking about what's going to happen with the election. There should be some consideration on what the interest rates are doing for their exit buyer, right? If affordability is not there and rates go up, then that borrower might not be able to qualify for that high of a loan amount. So, just based on interest rates, right?
Yeah. It kind of seems to me that California is a little protected by, at least the market is a little bit more protected from what interest rates are doing in general, because it just seems like, at least in Southern California, there's so much affluency here that I don't know. A lot of, like, sometimes I'm thinking, like, how did all these people have all this money, to put down? But it seems like there's always going to be somebody buying, especially when there's not enough homes for sale that's, to meet the demand and whatnot. Are you running into issues with that out of state? I know, during COVID, certain states appreciated like so rapidly, and then they've kind of come back now.
Yeah.
Have investors run into issues with that where they may have bought at the wrong time and then they weren't able to get rid of the property once they finished their project?
Yeah, I mean, yeah, there is a little bit of, I'm thinking, I always go back to stories, right? I've got a borrower that did a 4-unit out of state, and we got a as is value, we got an after repaired value, and it's a BRRRR. He's trying to get his money, his imputed equity back out, and some gained equity back out, so he can get all his cash back out. And the after repaired value, 8 months later, didn't come in where it came in initially. So he's just, he's going to have to, he's got his equity in the deal. He's going to have to, he might even have to bring cash to the table to refinance that deal, to get out of the bridge loan.
Wow.
Yeah.
Yeah. Would you say that California, I mean, I know I'm kind of generalizing here, but it's probably more profitable to do fix and flips versus fix and hold
in California?
and do DSCR versus other states where you can refinance it into a DSCR loan and still potentially be cash flowing afterward. Here, I mean, depending on, I guess, the price point and what you're buying it for, they could be a pretty hefty mortgage still, even after you're refinancing the property.
Yeah. No, it's tough. It's tough to find cash flowing rental properties in California. And I think the strategy for an investor, I've had rental properties here, and the strategy for the real estate investor is house price appreciation. It's having, hopefully, breaking even on that. So people still do it here, and they might, on their imputed equity, their down payment, they might not be making much of a cash on cash return, but they're getting house price appreciation. It's basically parking your money, right? You park your money in that deal and you're breaking even. You're not bringing cash to your mortgage payment every month. Maybe you're making a buck or two, but in 5 years, you might see 20% year over year HPA, right?
I think so. We were talking about cap rate. That's what that is, right? The asset value compared to the net operating income. So historically, California is not great because of just where rents are compared to the values. Thinking about that with rents, California is also known for maybe being more restrictive for landlords compared to other states. But from a flip standpoint, can you think of anything legislation-wise that a flipper would run into if it was in a different state versus California? That seems to be more of a federal guideline, doesn't it?
As far as like landlord-tenant rules, or
I guess what I'm saying is that that is a consideration if you are doing the buy hold strategy, is what's the local legislation? Because even county to county, maybe even city to city could be different.
Yeah.
It's more generalized if you're a flipper, correct? You're not worried about that as much if you go into a different county or even a different state.
Yeah, I mean for the landlord laws here are the eviction laws here are very pro-tenant. I think we all know that it takes a long time, and the tenants have so many rights and so many defenses. There's states, I invest in Utah, and I can get an eviction done in 21 days. I mean, from notice to, if they're not cooperating, notice to lockout in 15 days. And Georgia's very landlord friendly like that. You get into, it's municipality, I guess, is the answer. It's state by state or county by county or city by city. You get into New York, an eviction, I've seen evictions go years, and foreclosures take years. And in California, foreclosure time used to be you could file a notice of default after 30 days. You could do a notice to sell in 120 days, and then 21 days later, they're calling the sale. There's so many defenses. It's a non-judicial state, but there's so many defenses and so many things that the borrower can do to slow that process down, that it's become a nightmare in California. And eviction's the same way. Yeah, it's different state by state. I think a lot of investors that are doing the rental will find states where that's one of the boxes you check. Like, is it landlord friendly? Is it tenant friendly? What's that process? Not necessarily the foreclosure process, but for us, I mainly try and stay or minimize the states that have the judicial process for foreclosure. Not that we're by any means a predatory lender, but we don't want to get into a situation where somebody gets in trouble and we have to take the property back, and then we're going to run up years and years of attorney fees.
Yeah, I think people need to know that no lender wants to take the property back. That was not the intent for anybody when doing the loan. They want you to be successful and be making your payments. Yeah, so I think that if you're evaluating properties and trying to figure out what kind of decision you want to make, it's an interesting piece. It's like, and maybe why we see more flips in California than the buy and holds, right? It's like, what's the local cap rate? What's the local legislation? What's the market stability? And that can help guide somebody on what their investment strategy would be.
Yeah, for sure.
One thing that Mike and I are real big on following on a daily basis, since our primary business is helping first-time home buyers, primary residence purchase, all that stuff. We're constantly monitoring what interest rates are doing and what all the different reports and news and data that's coming out. And for these types of loans, these short-term, hard money or construction loans, if you will, tend to not be so sensitive to everything that's going on. Correct me if I'm wrong, right?
You're right, absolutely.
Yeah. What does primarily influence that, and can you give us maybe just a general example of what financing might look like for somebody that wants to get into investing and do a construction project?
Yeah, it's of course, if there's an alternative, I'll go into the rates, and for us, it's risk-based pricing. So, where are we getting that return? How do we get a return on our cap? We're a balance sheet lender, typically. I do broker loans, or I have capital sources where if someone can get a better deal, I'll bring the loan for the borrower. The borrower can get a better rate, I'll bring it somewhere else. But there's so much capital in this space, and we have rate compression from competition. And it's, so everybody's rushing, trying to keep it low, early adaptive pricing, trying to beat the next guy. Like, the big box lenders are all competing, and we have to do the same thing too. But it's just it's risk based. So if I wanted to make 5%, I'd go buy a CD, right? So I mean, how much more risk am I taking than a CD at 5%? And it's the same everywhere. Where can you put your capital to make it work? And this industry has become it's becoming very standardized. So everybody's figured out their risk. Everybody's got their underwriting guidelines and their process. And now it's, how do we get more volume? So the more lenders there are in the space, the more the rates we get rate compression. Not influenced really by short-term interest rates or the 10-year, I would say. I mean, we're not tied to the same kind of index as you guys are, but right now, a well-experienced borrower, we had, 3+ is to get that higher leverage. 5+, you might get that higher leverage plus a little bit better rate. 10+, the rate starts coming down and everybody's competing for that. And you've got, $300,000 in that deal. I would rather go put $300,000 in a CD or in a private mortgage fund and compound my income. We had to battle the appraiser on the market rent. Okay, we'll finance 80% of the purchase like you were going to do, and we'll finance 100% of the repairs, get that property back up to market value. Minimum repairs are $10,000 in that loan.